Good afternoon, and thank you for joining us. I'd like to take this opportunity to explain the Reserve Bank Board's decision earlier today and to answer your questions. Earlier today, the Board decided to increase the cash rate target by 25 basis points to 35 basis points and to increase the interest rate paid on exchange settlement balances from 0% to 25 basis points. It also decided to not reinvest the proceeds of the government bonds as they mature over coming years. These decisions reflect a judgment by the Board that it is now time to begin withdrawing some of the extraordinary monetary policy support that was put in place to help the Australian economy during the pandemic. Two considerations are particularly relevant here. The first is that the economy has been very resilient. Unemployment is low and economic growth is expected to be strong this year. The second is that inflation has picked up more quickly and to a higher level than we had expected, and there is now evidence that labour costs are increasing more quickly. In these circumstances, the Board judged that it was now appropriate to start the process of normalising monetary policy in Australia. I acknowledge that the increase in interest rates comes earlier than the guidance that the bank was providing during the dark days of the pandemic. During that period, and especially in 2020, the national health situation was precarious, the economic outlook was dire, and it was clouded by a lot of uncertainty. The Board wanted to do everything it could in those circumstances to help get the country through that difficult period. In those unprecedented times, we judged that the economic damage from the pandemic was likely to require that interest rates remain low in Australia for years. As things have turned out, though, the economy has been much more resilient than we had expected, which is clearly very welcome news. The combination of fiscal and monetary support has worked, and the development of vaccines in record times has allowed our society to return to more normal functioning more quickly than we had expected. Australians have also proven to be resilient, and we have adapted well to our changed circumstances. As a result of these developments, unemployment now stands at 4%. It's expected to decline over the rest of this year to around 3.5% at the end of the year and into next year. If so, that would be the lowest rate in almost 50 years. It's a remarkable achievement. Labour force participation has also risen to a record high, and a higher share of the working age population has a job today than ever before. The economy is also expected to grow strongly this year, with the Reserve Bank's central forecast being for GDP growth of a little above 4% this year. This resilience of the economy means that the record low interest rates are no longer required. The other major development has been on the inflation front. Over the year to the March quarter, CPI inflation was 5.1%, and in underlying terms, inflation was 3.7%. These numbers are lower than the inflation rates in most other advanced economies, but they are higher than we have experienced for many years, and they are higher than we were expecting. The main driver of the higher inflation has been global developments, with a series of major global supply shocks pushing prices up over the past year. The pandemic has interrupted supply chains, and it continues to do so with the recent lockdowns in some of the large Chinese cities, again disrupting production and transport. And on top of this, Russia's invasion of Ukraine has resulted in sharp increases in the price of oil and gas, of base metals, and of many agricultural commodities. Inevitably, these shocks to global prices do flow through into higher inflation in Australia. But the higher inflation outcomes have a domestic component as well. There are a number of areas where strong demand is now putting pressure on available capacity, with many firms reporting that it's quite difficult to hire workers with the right skills. This pressure on capacity is reflected in the broadening of the areas in which prices are rising more quickly than they have over recent years. Firms in a range of industries are now indicating that they are prepared to pass on cost increases through into higher consumer prices. Looking forward, we expect a further increase in the inflation rate as the effects of global developments wash through the year-ended inflation figures. But we then expect inflation to start receding as some of the supply disruptions are resolved and as prices settle at a higher level. I think it's important to remember that for inflation to stay high, prices need to keep increasing at a fast rate, not just settle at a higher level. An offsetting influence to the resolution of some of these supply-side problems will be stronger growth in labour costs in a tight labour market. Our central forecast, which is based on an assumption of further interest rate increases, is that underlying inflation will decline to the top of the target band in 2024. But if interest rates were to remain unchanged, inflation would be higher than this, perhaps substantially higher. Over recent years, the Board has placed considerable emphasis on trends in growth in labour costs when making its decisions. This is because over the medium term, there is a strong link between the inflation rate and the rate of growth in labour costs. Given that we operate a flexible medium-term inflation target, we are generally prepared to look through year-to-year variability in the inflation rate caused by supply-side developments or exchange rate movements. This is because if these shocks do not flow through into a permanent change in the growth of labour costs, inflation should return to the lower rate once the supply-side shock washes through. But if the supply-side shocks do lead to a permanent or a persistent shift in labour cost growth, inflation will not return to where it was before, so there can be path dependence in the inflation rate based on the supply-side shock. This focus on trends in labour costs has been evident in the Board's communication over recent meetings, including last month, when we stated that over coming months we would be assessing important additional evidence on both inflation and the evolution of labour costs before deciding on interest rates. The evidence that we have received on inflation since then has been clear. Inflation has been high, and it's been higher than we were expecting. On labour costs, while the various data for the March quarter compiled by the ABS have not yet been released, other evidence received over the past month through our business liaison and through business surveys has indicated that there is now stronger upward pressure on labour costs and that this is likely to continue. And we expect to see this in the ABS data over the period ahead. In a tight labour market, some firms are paying higher wages to attract and retain staff. This is especially so given the higher inflation rate and the fact that workers are experiencing cost of living pressures. So firms are responding to these developments. There is still considerable inertia in the wages system from multi-year enterprise agreements and the current public sector wage policies, but the direction of change is now clear. Given this evidence on inflation and on wages, and the very low level of interest rates in Australia, the Board decided that now was the right time to start the process of normalising interest rates. We also decided that we would not reinvest the proceeds of maturing government bonds. This means that our bond holdings and our balance sheet will decline as the bonds mature. Our balance sheet will also decline substantially in 2023 and 2024 as banks repay the funding made available under the Term Funding Facility. This contraction of our balance sheet will contribute to some tightening of financial conditions in Australia, and so it will assist with the return of inflation to target. The Board currently has no plans to sell the government bonds that it's purchased during the pandemic, and it intends to allow the portfolio of bonds to run down in a predictable way as the bonds mature. This decision to proceed with quantitative tightening does not rule out a return to quantitative easing sometime in the future should circumstances require that. Given the outlook for the economy and for inflation, further normalisation of interest rates will be required. In making its decisions, the Board will continue to be guided by the evidence on both inflation and labour costs. We'll also continue to be flexible and responsive to changing circumstances. We will do what is necessary to ensure that the inflation outcomes are consistent with the medium-term inflation target. This does not require an immediate return of the inflation rate to target, because our monetary policy framework intentionally allows for flexibility and for some variability of inflation from year to year. But we do need to ensure that the inflation rate does track back towards the 2 to 3% target. I think this would be harder to achieve if the inflation psychology in Australia were to shift in a durable way due to the recent higher inflation outcomes. The decision to move today rather than wait should help on this front. In making our decisions over coming months, we need to navigate through some considerable uncertainties. Globally, it remains uncertain about how the supply side problems will be resolved, and it's still very uncertain how the situation in Ukraine will develop. Another source of uncertainty is how household spending in advanced economies responds to the decline in real wages, as wages growth in most countries has not kept pace with the higher rate of inflation. Also, we have no contemporary experience to guide us with how labour costs and prices in Australia will behave at an unemployment rate below 4%. It's also relevant that households have much more debt than previously, and many households have never experienced a rise in interest rates. So this is another aspect that we'll be watching very carefully over the months ahead. Notwithstanding these uncertainties, I expect that further increases in interest rates will be necessary over the months ahead. The board is not on a preset path, and it will be guided by the evidence and the data as it takes the necessary steps to achieve the medium-term inflation target and support full employment in Australia. Thank you very much for listening, and I'd be happy to take your questions.
Mr. Lowe, you're using
Thank you. Sorry, could you wait for just 1 minute?
Oh, sorry.
We're just going to tell everybody on the line how to handle this. Thank you. We'll now move to the Q&A. Please raise your hand if you're in the room with a question, and we'll assign you at that time. And if you're on the line, please press *1 to join the queue. Could everyone please limit themselves to one question and one follow-up if needed, and we'll start with some questions in the room. So actually we'll start with Hayley Francis from Channel 9, if that's okay.
Can you tell us how much is the election weighed into today's decision?
The election has no influence at all on today's decision. The Reserve Bank has been given a mandate by Parliament, that is to achieve price stability, full employment, and to promote the economic welfare of the Australian people. We have operational independence, and it's testimony to the political culture in Australia that that independence is respected. We take our decisions in the best interests of the country, and that's what we always do, and that's what we did today, and we do that without any interference from politics, and we don't take the political situation into account. We do what we think is right for the country.
Next question. This is Robert Evardis from Channel 7.
Thank you. You mentioned spiralling labour costs, the correlation with inflation and the uncertainty of what's happening in the Ukraine at the moment and supply from COVID. So all of those don't augur particularly well. You also mentioned the term medium term. Can you define what medium term is, please, sir? And when you talk about a number of rate rises over the coming months, can Australians expect a quarter rise every single time the RBA is going to meet over the next 6 months or so? What sort of increase are we talking here? Keeping in mind you are gun shy about predictions given what's happened.
I obviously don't want to kind of predict what the board's going to do over coming months, but I think what I can say is that the midpoint of our inflation targeting band is 2.5%. I've said previously that I would expect that at some point in the future that interest rates would get back to that level. So after all, that would mean the inflation-adjusted interest rate was 0. I hope actually over time we can do better than that, but that would require stronger productivity growth in Australia. But over time, it's not unreasonable to expect that the interest rates would get back to 2.5%. How quickly we get there, and indeed if we get there, will be determined by how events unfold. We're going to be, as we have been up until very recently, guided by the evidence. And it will depend upon how the resolution of the various uncertainties that you just cited occurs. We've got an open mind. We've been, over the past 2 years, very flexible. We've changed in response to the changing circumstances and will continue to do that. But it's not unreasonable to expect that the normalisation of interest rates over the period ahead could see interest rates rise to 2.5%. That would be a more normal level of interest rates. And how fast we get there and whether we get there is going to be determined by events.
Follow-up question. Has there been even one phone call from any tier of government or the opposition in relation to your decision today?
No. As I said before, it is a testimony to the political culture in Australia that the Reserve Bank can take its decisions completely independently of politics. We make decisions in the national interest. I know those decisions are not always popular, they're contested, and in some cases they're controversial, but the government of the day appoints 9 Australians to make those decisions, and we take them in the national interest with no political interference, and we don't take account of politics in making those decisions either. It really is testimony to our political culture that can be the case, and that's not the case in every other country, obviously.
Another question from the room. This is Ed Boyd from Sky News.
Governor, do you believe you're behind the curve and you've come to this cash rate rise a bit too late? With soaring inflation across the economy, will you admit that you're playing catch-up now?
I don't see it in those terms that we're playing catch-up, but I do see it in that we need to normalise interest rates. We have said right through the pandemic we would wait for the evidence on both inflation and wages. We intentionally did that because we wanted to get out of the low inflation years that we'd been in previously. We made a commitment to wait for the evidence. That evidence is now upon us. It was clear there in the CPI, and the evidence on wages is there in our liaison. I think we'll see it in the published data over the coming months. Having got that evidence, it's appropriate to move, and we will move to normalise interest rates, and I expect to see further increases over the months ahead. But we wanted to wait for the evidence. That was a conscious decision we made. And I know when you're waiting, people will say sometimes that, well, you waited too long, and people will make that point. But we wanted to wait for the evidence, and as soon as we've seen the evidence, we've moved.
And Governor, just as a follow-up, how long is it going to take for the cash rate to get to that 2.5% level? How far off are we talking? Well,
it's a very good question, and I don't want to make a prediction on that for you. It will depend upon how these various issues resolve. It's quite possible that the supply side issue is resolved, and even if, so for the price of oil, it stays where it is, then the inflation rate in oil prices becomes zero. It was 35%. The oil prices were up 35% over the past year. If the oil price stays where it is, that'll be zero next year. The price of home building is up 13.5% over the past year. So the cost of building a new home's up a long way. It's quite possible that it continues to rise, but probably not at another 13%. So there are reasons to believe that inflation will start moderating, but on the other hand, the labour market's tightening. So it's difficult at the moment to predict for you how those factors are going to play out, but the main point is that it is time to normalise rates. We don't need these emergency settings anymore. With an unemployment rate of 4% and probably likely to go lower, and economic growth this year of 4%, we don't need these emergency settings anymore, and it's good news. I know many people don't like rising interest rates, but it's a reflection of the underlying strength of the economy that we can move up these emergency settings.
Next question from David Chow from the ABC.
Governor, so it was only months ago the RBA reassured the public that rates are unlikely to rise until 2024, and then more recently it's plausible they might rise this year, and indeed there was a rate hike today. So no doubt many borrowers relied on the RBA's previous guidance and took up massive debts to get into the property market in reliance on the fact that it might not rise till 2024. But I guess they're in the unfortunate predicament that house prices are starting to fall, and they may fall into negative equity, especially in Sydney, Melbourne, and those expensive markets. So I guess what would the Reserve Bank say, to those borrowers, who I guess were listening to the guidance of the Reserve Bank, which has changed, rather quickly in a short amount of time?
We've certainly changed the guidance, and we've changed it because the economic circumstances have changed. nobody predicted, at least to my knowledge, that we would be looking at the lowest unemployment rate in decades now. You might recall that during the dark days of the pandemic, through much of 2020, people were talking about an unemployment rate in Australia of 15%, that there would be deep scarring that would take many, many years to overcome. So that was the situation that people were thinking through 2020. Fortunately, things have worked out much better than that, which means that we don't need these very low level of interest rates that we thought we would need. And I know it's coming as a shock to many people, but it's a testimony to the resilience of the economy and the fact that more Australians have jobs today than ever before. I think the other thing, the other point I would make is that Australians have understood that interest rates would go up at some point. None of us understood really at what point that would be, but I think we all understood that at some point interest rates would go up. They didn't know when, but they knew they would go up, and they've responded appropriately. Over the past couple of years, households have saved an extra $240 billion over and above what they otherwise would have saved. They've squirreled that away. It's in bank accounts, and the average owner-occupier with a mortgage is more than 2 years ahead of their mortgage repayments. Back in 2018, they were only 1 year ahead. So they've saved a lot of extra money, and they're ahead. Many people are ahead of their mortgages. Loan arrears at the moment are very low. So people have understood that interest rates would go up. It's happening earlier than I expected, and I'm sure it's happening earlier than many borrowers expected, but I think we all knew that interest rates couldn't stay at this current level forever, and many people have saved in advance of that day, and I think that's very sensible behaviour.
And if I may, Governor, just have a quick follow-up question. So I think in the post-meeting statement, the RBA is expecting inflation to fall back to, within a target band sometime, next year or 2024, as the supply shock, factors dissipate. But these are big ifs too. Like no one knows how long the Russia-Ukraine war will last. The slowdown of the Chinese economy. So, is there a chance you might have to revise these future lower inflation forecasts in the very near future?
Well, the world's probabilistic, isn't it? So I can't say there's no chance that that's going to happen. All the inflation surprises in the past 6 months globally have been to the upside. We've responded to that with a revised set of forecasts, and we're expecting the headline inflation rate to get to 6% and then to gradually come down. But you're right, if the supply side problems get resolved quickly, China gets on top of COVID, there's a peaceful resolution in Ukraine, the inflation outlook could look quite different. But as you say, they're all big ifs.
Okay, we might go to some questions on the phone. If I could ask everybody maybe to limit themselves to one question, because we've got a number of people who would like to ask something. The first person on the line is Ron Meisen from the Financial Review. Ron?
Good afternoon, Governor. Thank you for your time, as always. When we spoke, or when we had a question and answer session in November last year, you said that rate rises were plausible in 2023, and in February you said they were plausible in 2022. The markets have been tipping rate rises in 2022 for quite a long time, and you previously labelled that a complete overreaction to inflation data. I just want to see, why do you think the markets have got this so right over this period while the RBA hasn't? And the markets are currently pricing in a cash rate at 2.75% by December. Do you think that's plausible?
I don't want to offer any comments on the plausibility of market pricing. Why have interest rates increased more quickly than we had expected and broadly in line with the market? I think that the main reason is that inflation has surprised everyone on the upside. Even people who thought we were going to raise interest rates quite quickly. My understanding is they did not predict 5% inflation or even 6% inflation. So this has come as a surprise to us all, not just here in Australia. I know in the US at the beginning of last year, the Fed thought that inflation in 2021 was going to be kind of 2 and a bit percent. It's turned out to be 8. So it's come as a surprise to all central banks and to most market forecasters. and in response that we've had to increase interest rates earlier than we expected. Why the market pricing got the timing more accurate than we did, I'll have to leave others to make a judgment of that. But this is inflation surprises has really been a big one, and we've had to respond to it.
The next question is from Chris Reid from Morgan Stanley.
Yeah, thanks for your time, Governor. I guess my question is more specifically around the rate path that was used within your economic forecast. Can you just confirm, is that similar to the last S&P where that's an average of market economist expectations and market pricing? And would you view that, given that results in inflation only just touching the top of the target band in 2 years' time, is that really the minimum of rate hikes that's required, at least given your current understanding of the economic outlook?
Well, I can confirm that we've used the same assumption as last time, an average of the market path and the economist's path. And just to be specific about that, we're assuming in preparing these forecasts that the interest rate by the end of the year is between 1.5% and 1.75%, and then by the end of next year at 2.5%. So that's a technical forecasting assumption. It's not a prediction, it's not a policy prediction, but it's a technical forecasting assumption. And based on that, those assumptions, the inflation rate does come back to 3% in 2024. There's a lot of, there's just a huge amount of uncertainty, so I don't think you want to read too much into that, but from a forecasting point of view, that's the technical assumption we've made, 1.5% to 1.75% by the end of the year and 2.5% by the end of next year. And it's not unreasonable, an unreasonable set of assumptions to make, but will depend, as I said before, on how things develop. Sorry, Judy.
That's okay. The next question is from Patrick Commons from The Australian.
Thanks very much, Governor. My question is, how confident are you that you can contain inflation over the coming year or two without sending the economy into reverse?
The economy's got quite a lot of positive momentum at the moment, hasn't it? We're expecting growth to be 4% this year and roughly 2% next year. The number of job ads at the moment is at a record high. Job vacancies at a record high. Firms tell us they want to hire more people. So there's quite a lot of positive momentum at the moment. So I think it's quite unlikely that all that positive momentum would be completely lost. And it's not going to be lost by relatively small movements in interest rates. So as we all know, the future is inherently uncertain, but at the moment the economy looks like it has quite a lot of positive momentum, and that's clearest in the labour market.
The next question is from Shane Wright from The Age.
G'day, Governor. My question goes to fiscal policy. The government has announced in the budget $5 billion in cost of living relief, plus the $12 billion that's going to come from the middle of the year through the enhanced low and middle income tax offset. Plus, there's been several billion promised by both sides of politics through the campaign. Was there any discussion today about fiscal policy, and does that, it's about 1% of GDP coming into an economy that you say has a lot of positive momentum with people say an extra $240 billion in savings? Doesn't that make bringing inflation under control more difficult?
I'm not going to be drawn on fiscal policy. I'm here to explain our decision today. What we did talk about this morning was the growth outlook for the Australian economy. And as I said, we're expecting growth of 4% this year and the unemployment rate to come down to 3.5%. Fiscal policy plays some role in that, but there are broader factors at play, including the recovery from the pandemic, the fact that firms need to invest after a period of underinvestment, and the fact that household savings are still high and households have a big buffer of savings to draw on. So they're the factors that are driving the economic recovery, and fiscal policy is playing some role, but these other factors are more important.
The next question is from Andrew Ticehurst from Nomura, Australia.
Governor, thank you for holding this briefing. You said a few moments ago that 2.5% represents a more normal level of interest rates. Could you please clarify for us, does that mean that you think the neutral nominal cash rate right now is roughly around 2.5%? And do you think it will be necessary to take that cash rate into restrictive territory to bring inflation back under control?
I think working out what the neutral rate is very difficult, and I don't want to be pinned down on a particular number. I think it's quite plausible that the neutral real interest rate is positive. If the economy can generate reasonable productivity growth, I'm sure the neutral real rate is positive. So my hedging here is really around the fact that I don't really have a good handle on what underlying productivity growth in Australia is likely to be. The higher it is, the higher will be the neutral real rate. I think it's at least, in real terms, 0, which would mean that we'd have to get back to 2.5%. And whether we need to have interest rates higher than that, it remains to be determined. But it really comes down to what you think underlying productivity growth is. If underlying productivity growth is strong, we're going to have higher equilibrium interest rates, we'll have higher growth in real wages, there'll be more government revenue, and we'll have stronger asset prices. So much of this comes down to stronger productivity growth and re-energising the productivity growth agenda in Australia.
The next question is from Su-Lin Ong from RBC Capital Markets.
Good afternoon, Governor. I was wondering whether any other quantum changes to the cash rate were considered today. Was 15 basis points or 40 basis points part of the discussion? Was 25 a compromise, or was 25 delivered to put a bit more focus on the ES balance rate?
No, well, we kind of consider, as we always do, a range of options, so that the options that you just mentioned were certainly ones we talked about. But the 25 basis point increase wasn't a compromise decision. It was one that we agreed was the right amount. We want to get back to business as usual. In the past, 25 basis points was the standard amount we moved. We deviated from that in various times in the past because circumstances required it. But 25 basis points is the standard move. We want to signal we're getting back to business as usual. Things are normalising, and 25 basis points was the right number. It doesn't preclude a bigger or a smaller number in the future, but we want to signal that really things are getting back to normal. It's business as usual. We're making a standard adjustment in interest rates. 15 basis points would have been small, and 40 basis points to take us to 50 would have been, a larger than normal. So we want to get back to normal and business as usual.
The next question is from Tapper Strickland from National Australia Bank.
Hi, good afternoon, Governor Lowe. It seems like you have relied a lot on evidence from Liaison for labour costs picking up. How confident are you that it reflects what is going on, and does this mean you will de-weight the signal from the WPI over the next few quarters?
No, we're not going to de-weight the signal from the WPI, but each month we talk to many businesses, and we always ask them what the wage increase they're currently paying is and what the wage increase they expect to pay over the next year. And in the past 2 months, there's been a very marked shift. Most firms used to say, well, 2, maybe 2.5%, and now we have roughly 40% of firms answering that question, saying they're going to pay wage rises above 3%. And a significant number of firms saying they're going to pay bigger wage rises than 3%. So that's quite a big change just in the past 2 months. It's consistent with the discussions that we're having, ongoing discussions we're having with other businesses as well. And you're starting to see that in the business surveys as well, undertaken by the banks and others, where they're asking about growth in labour costs. So it's a very clear message coming through all these channels that labour costs are on the move. I think in time we'll see that in both the wage price index and in the measure of labour costs from the national accounts. But the message from our liaison, as you picked up, is very clear at the moment. Wages growth in Australia is finally picking up. This is something that we welcome. For too long, I think wages growth had been stuck in the 2s. It now seems to be moving into the 3s for many businesses, and in some cases where labour is in short supply, to the 4s. So that's it's a welcome development. It's a byproduct of a tight labour market, but it does mean that the time for emergency settings of interest rates is over, and we have to normalise.
Next question is from Prashant Munaha from TD Securities.
Good afternoon, Governor. The language in today's statement is very similar to that employed by the BOC and the Fed, in that you're all committed to reining inflation. And the BOC and Fed appear intent on front-loading hikes and getting to neutral quickly. Is the RBA also intent on front-loading hikes like the BOC and the Fed?
Well, I'm not sure that I'd agree completely with your characterisation of the Fed and the Bank of Canada, but we are committed to normalising monetary policy as conditions allow. As the unemployment rate continues to come down and the evidence on wages and inflation continues to accumulate, then we'll normalise interest rates. We're not on a preset path here. We haven't made any decision about the future size of upcoming interest rate changes. We're going to respond to the conditions as we see them. So we haven't made a decision about upcoming interest rate movements in terms of whether we need them and what size they're going to be. So we've got an open mind and we'll be guided by the evidence here.
The next question is from Jonathan Shapiro from the Financial Review.
Thanks, Dr. Lowe. My question is about quantitative easing, or I guess the balance sheet. I just wondering how, obviously, quantitative easing and the bond purchases was a big part of the stimulus and easing financial conditions. I just wonder, how should the man on the street think about the balance sheet from here? How do you plan to calibrate, either speed up or slow down the timing of the balance sheet runoff to tighten conditions and get inflation back to where you need it to get to?
Well, I think the person on the street shouldn't really be thinking about this. And our balance sheet is projected to decline. I hope to see that really being on autopilot. We've laid out clearly that we don't intend to reinvest the maturing bonds, and we have no current plans to sell any bonds. So you can think about the balance sheet withdrawal being on autopilot and not a material influence on monetary policy from here on in. The main tool for adjusting monetary policy is to the cash rate, and we're returning to this world of normal where interest rates move around because of the outcomes on inflation and the labour market, and that's going to be our tool of choice from now on. And I hope that the person on the street doesn't have to worry about our balance sheet for some time. Better things to worry about.
The next question is from John Rolfe from the Daily Telegraph.
Thanks, Governor. Your initial written statement today mentioned an inflation rate of about 3% by mid-2024. Given your comments in this Q&A regarding 2.5% inflation and a 2.5% cash rate, does that mean that by mid-2024 we can expect the cash rate to be near 2.5%?
Well, it will depend. As we were having this discussion before about what the neutral rate is, got an open mind about that. If productivity growth is really strong, then I'd expect it to be higher than that. But if it's weak, then the equilibrium interest rate is lower than that. So I don't think you can read any particular path of interest rates into these forecasts. As I said before, the forecasts are predicated on interest rate getting to 2.5% and that leading to inflation coming back to 3%, but there are a lot of ifs there. Now, there are so many uncertainties, and I think it's too hard to stand here today and say, look, we have a great deal of confidence that interest rates are going to peak out at some number, 2.5% or some other number. It depends very much on how you view the equilibrium neutral rate, and that remains to be determined. We've got an open mind and we'll respond to the data as they come in.
The next question is from Stephen Halmarick from the Commonwealth Bank.
Good afternoon, Governor. Thanks for doing this. So there's been lots of great questions on how high interest rates might go and your outlook for wages. So thanks for your clarity on that. I wanted to ask also about the quantitative tightening program as you've described it, so allowing the balance sheet to run off. Now, what impact do you think that might have on, on bond market yield, on bond yields, and particularly on funding costs for financials and companies in Australia? And when you talk about the neutral rate, do you mean the cash rate, or do you mean actual borrowing rates that businesses and people in Australia will have to face? So standard variable rate or and business borrowing rates. Thanks.
I think this discussion we've been having through the course of this briefing is on the neutral rate is really in terms of the cash rate. So, as I said before, I hope that we get back to the point where we have at least a non-negative real cash rate. That would require the cash rate to be 2.5% if we're going to get inflation back to 2.5%. So that's it's really about the cash rate. I've lost track of the first part of your question. It was, I think, can you just, it was about quantitative easing, but I lost track of what you're asking when you moved to the neutral rate.
Stephen Halmarick, are you still on the line?
Hear me?
Yeah. So I lost track of the first part of the question.
The impact of quantitative tightening, so allowing the balance sheet to shrink on bond yields and actual borrowing costs for Australian companies and people.
Yep. It's a good question. I think the announcement on not investing the maturing bond proceeds is unlikely to have any impact at all on bond yields. Because what's important is how our announcements line up with what people had expected. Bond markets are forward-looking, and my understanding is they had already priced in today's decision. If we had made a different decision, if we'd made a decision to continue to reinvest the proceeds, then I think that would have forced bond yields lower and possibly the exchange rate lower. The fact that we made an announcement that was in line with what people expected means that it has very little impact from here on bond yields or the exchange rate. And that's how we want it to be. We want people to return to a world where they're thinking about the cash rate as the main tool for monetary policy. We had to buy bonds when the cash rate was effectively at the zero lower bound. It couldn't go any lower. We wanted to deliver more stimulus to the economy. We had to buy bonds, but those days are over. So our plan now is to allow the bonds to mature, to run off over time, not to sell them, but to allow them to run off over time and to return to a world where the cash rate's the instrument of monetary policy. That doesn't mean that the situation couldn't develop where we had to return to a world where we had to buy bonds again, but let's hope that doesn't happen.
The next question is from John Kehoe from the Australian Financial Review.
Thank you, Governor. Just reflecting on the forward guidance on interest rates over the last couple of years, notwithstanding you point to, challenges with the pandemic, it's difficult to forecast, grant you that. But, how would you reflect on forward guidance as a tool? And I notice you're being a lot less certain in how you're looking at the future today. Do you think forward guidance as a tool maybe was overused and you'd be more reluctant to use it in the future, given the lessons that have been learned from some of the inaccuracies on it?
Yeah, it's a very good question, and later on the year the board's going to have a full review of how forward guidance has been used and how we should use it going forward. So towards the end of the year I'll be in a better position to answer that question. But I just want to make one general point, and that is really to ask you to go back to 2020. We were faced with a global pandemic. We were being told that it would take many, many years for vaccines to be developed, that people could be locked down for a long period of time, that tens of thousands of Australians would die from the pandemic, that our hospitals would be full, that we would have double-digit unemployment, perhaps 15% unemployment, that there would be deep scarring that would last for years, perhaps decades. That was the situation we were making decisions in 2020. And in that situation, the board decided that it wanted to do everything that it could possibly do to help the economy through what was a truly horrific outlook. I didn't want to leave any stone unturned in that very difficult situation. The Reserve Bank wanted to do everything it could do to help the economy through that period, and one of the things that we could do is to say, be very clear about what we saw as the outlook for interest rates, that we would keep them low for as long as was necessary, and at the time we thought it was going to be necessary after 2024. So that was our mindset. Thankfully, we were wrong. The economy has been much better. The unemployment rate has come down, the economy has been strong, Australians have been resilient, they've adapted, and interest rates are normalising much quicker than we thought was going to be the case. So from a forecasting perspective, that's embarrassing. We should forecast this better. We didn't, but what we did do in 2020 was make sure that we took every possible step that we could take to help the country, in the full knowledge that if things turned out better, we'd have to reverse the policy stimulus more quickly, that I'd have to go back on the forward guidance, that it would be embarrassing. But at the time, thought that was the right decision. In retrospect, given the same situation, I'd probably make the same decision. So I think it was incredibly important at the time to provide confidence that both the central bank and the government would do the right thing. We would stand by Australians and make sure that the country could get through this with limited economic damage, and it's worked. And so because it's worked, we're having to change interest rates earlier than we thought. That's a bit difficult to explain, but I think it's basically a positive story, a story of resilience, of people with jobs, finally of rising incomes, and certainly we didn't expect that to be the case. So that's a long-winded answer to your question, John, but we will be taking a full review of forward guidance later in the year, how we're going to operate in a world where hopefully things are more stable and the shocks are smaller.
The next question is from James Glynn from Dow Jones.
Hi, Governor, and thanks again for this press conference. Your business liaison is clearly full of anecdotes pointing to rising wages, and that's underpinned your decisions today. However, in the past, we've been here before, the business liaison has been chock-a-block full of these reports, yet it hasn't converted into high numbers in the actual data. In some ways, it's like gathering in the backyard waiting for the Roman candle to go off, but it just fizzles. And what will you do if the wage price index data in a couple of weeks is a fizzer? Will you just look through that and press on, confident that the wave of anecdotes will eventually come good?
Well, I'd say it's more than a wave of anecdotes. As I said before, we ask firms what they're increasing wages by at the moment, and that has shifted. I expect that the higher inflation rate will see a stronger increase in award wages this year. I expect that over time the governments will have to shift their wages policies. In a strong labour market with inflation as high as it is, anyone who wants to hire people to work for them will have to pay higher wages, and the message we're getting at the moment from the liaison is very clear. That's just one piece of information. She said the WPI will be another, and we'll have the national accounts measure later this month. I'm reasonably confident, and I say this with only limited hesitation, I'm reasonably confident that over coming months we'll see the stronger wage growth in most of the headline data series that we follow. If we don't, we'll have to work out why, but the message at the moment from Liaison is very strong.
The next question is from Robert Rennie from Westpac Bank.
Governor Lowe, many thanks for taking the time today. We've seen a number of central banks around the world announce 50 basis points, and that likely includes the Fed in the next day or so. And a number of Australian economists were actually forecasting 40 basis points today. So why wasn't 40 or 50 basis points under consideration, particularly 50 basis points, given the interest in getting away from emergency settings quite quickly? The other quick question, if I can, also interested in why the exchange settlement balance discount was kept at 10 basis points rather than being widened as we were used to in sort of prior history. Thank you, Governor.
The question of the size of the movement, as I said before, we wanted to get back to business as usual, of normal operating procedures where we're most of the time moving by 25 basis points and only deviate from that if there's a really strong argument for doing so. In the US, in Canada, in Europe, in the UK, inflation is much higher than it is here. The headline inflation number last week was a shock at over 5%. That's quite a lot different from 8%, 7%, which many other countries are seeing. So the inflation outlook here is not as serious. It's also the case that wages growth in Australia, while it's picking up, hasn't picked up like it has in the United States. So I can understand why they're talking about bigger numbers than we are. But in the circumstances that we face, we thought a standard adjustment of 25 basis points was the right decision, and the Reserve Bank Board meets every month, as you know, so we'll get to make another decision next month. In terms of the interest rate we pay on exchange settlement balances, if you have read the minutes from the previous board meeting, we had an extensive discussion on the way we were going to operate monetary policy going forward with high settlement balances, and we announced last time that our intention was to keep the gap between the exchange settlement rate and the cash rate target at 10 basis points. We're in a world with very high exchange settlement balances. We think that's likely to continue for some time, and given we're in that world, we thought the right deviation between the cash rate and the ES rate was 10 basis points, and you can find a fuller elaboration of that discussion in the minutes from last month.
We have another 5 questions to take us to 5 o'clock, but the next one is from Michael Heath from Bloomberg.
Governor, hi, this is Swati from Bloomberg. My question is around the consumer confidence data. We have been seeing a consistent drop in consumer confidence data, including today. Just wanted to understand how much is that going to weigh in your interest rate decisions, especially given that you mentioned that households are a lot more indebted today than they were previously.
What we're really looking at here is the trend in household consumption. Consumer confidence obviously has a role in influencing how much people spend, but the real influences on spending are: do you have a job? What's your wage increase? How much money do you have in the bank? And how much do you have to pay on the mortgage? They're the drivers of how much we each spend. And at the moment, people are getting jobs, and I expect them to continue to get jobs. Wages are increasing more quickly, inflation's high, so that's eating into people's real incomes. So we've got to weigh the effect of the decline in people's real incomes temporarily while inflation's high against the fact they are getting jobs. They should be confident they can continue to get jobs, and many people have a lot of money in the bank that they can draw on. I talked previously about the $240 billion that people have put away. So the issue is, how is the decline in real income going to offset or balance against the fact that we're getting jobs, We should be confident we'll get jobs and we've got a lot of money in the bank. And this is why I'm hesitant to be one of the reasons I'm hesitant to be drawn into the future of interest rates, how far they're going to go, because this is quite a big uncertainty, how these various factors are going to balance out. It's not consumer confidence itself that's the driver, it's these other things out, whether you've got jobs, how fast your wages going up and how much money you've got in the bank.
The next question is from Justin Fabo from Macquarie Bank.
Okay, Governor, thanks for your time. I know you've talked a lot about the kind of the wages stuff and liaison. I just wanted to press you a bit more on that. I think you've mentioned that it's more of a forecast still in terms of a pickup in wages growth rather than hard evidence from either liaison or surveys that it's actually been kind of percolating at a faster rate. And some other evidence that you haven't mentioned is when you look at consumer surveys, and their questions on wages growth, they're still not really showing a pickup in people's actual wage outcomes over and above what we're seeing in the WPI. So it might be coming, but is that fair to say that it's still a forecast and you're still waiting for it to happen over the next 3 to 6 months rather than actually seeing it in what businesses are saying? Thanks.
I don't think it's not just a forecast. Businesses are telling us right now that they are paying higher wages, or they've taken the decision to lift up the rate of wage increase in their firm. You talk to any business person in the country at the moment, they tell you it's hard to get workers, particularly with the right skills. They're prepared to pay more for them, and with workers experiencing cost of living pressures in a tight labour market, it's understandable why firms are paying higher wages, and they're telling us they're doing it right now. Obviously not every firm in the country is paying higher wages. In the public sector they're not, but many private sector firms tell us that they've already responded to the tight labour market and to the higher inflation, and I expect to see further responses in the months ahead. So we've got the evidence now, we thought we have the evidence now to move, and I think we'll see further evidence over coming months.
The next question is from Phil O'Donoghue from Deutsche Bank.
Thanks, Governor. I just wanted to ask, in the post-meeting statement you said that the board is not currently planning to sell the bonds that are purchased during the pandemic. Under what circumstances might that change, and has the board considered the cost and benefits of an active QT program? Thank you.
The possibility that we sell bonds, I think, is remote. But I'm hesitant to say never, because, as we know, the world can change in unexpected ways. But we discussed the possibility today about under what circumstances that we'd sell bonds, and they were so remote it's not worth elaborating on them. But it is an option, but it's an extremely remote probability option.
Last two questions. First one from Sophia Rodriguez from Central Bank Intelligence.
Thank you, Governor. So from a position of wanting to see a shift upwards in inflation psychology, so inflation moves sustainably in the target band, have you, in a span of less than 2 months, are you now trying to rein in that same inflation psychology so you can have inflation moving back to the target band? Is my assessment correct? And if I'm right, does it mean that front-loading rate hike becomes a necessity, not a choice?
We're not trying to rein in the inflation psychology. We had wanted the inflation psychology to shift. We'd been stuck in a world where inflation was consistently below 2%. I think it was becoming a problem. So we'd wanted the inflation psychology to shift, and it has shifted. The rate of wage growth, as I've talked about, is picking up, and I think it's quite unlikely that we're going to return to sub 2% inflation anytime soon. So the inflation psychology has shifted. We're moving today in a preemptive way, in a sense, to increase the probability that it doesn't shift too far. I would like Australians to know that we will take what action is necessary to get inflation back to 2 to 3%. So people shouldn't be worried that the higher inflation, the 5% rate, is going to persist indefinitely. We think inflation will come down because the supply side problems were resolved, and we're going to take the necessary steps on monetary policy to bring inflation back down. So I hope that people understand that we will take the necessary steps to make sure that inflation in Australia does not become a persistent problem. I don't think we have to rein in inflation psychology because it hasn't shifted in a troubling way yet, and we don't want it to shift in a troubling way, and today's decision, I think, helps increase the chance that that is how it works out.
The last question is from Tom Duspich from The Australian.
Thank you, Governor, for your comments on productivity. One of the lone voices out there and an important voice. So my question goes to the productivity agenda. If we had more competition in Australian product and factor markets, would that help you in your inflation fight and also improve productivity across the economy?
Well, I'm here today to explain what we did today, so I don't want to kind of elaborate on issues outside beyond what we talked about today, other than agree with the general principle that stronger productivity growth is good. It's going to mean higher growth in real wages, more resources available for the government to spend on goods and services for the community. It'll mean a higher equilibrium level of interest rates, which I think it would be good, and it would mean stronger asset values and a wealthier and more prosperous society. So today's interest rate decision isn't going to influence any of that, but I agree with your general sentiment.